not believe it will persist. With sticky inflation, tariffs and significant US fiscal deficits, the Fed faces challenges and term premium will come under pressure. Mike joins us now. He's also the former economic advisor to President Joe Biden. It's good to see you, Mike, as always.
See you.
Should we start there? How does it feel? Does it feel good? You've been shaking the Washington, D.C. off? Do you feel better about it?
I got a spring in my step. Happy to be back in New York and happy to be with you.
We can get into the markets in just a moment. I'd love your assessment of where the economy is and how these policy changes might influence where the economy goes in the coming quarters.
Yeah, I mean, certainly I think we're in the midst of a pretty significant set of shocks. So obviously trade policy uncertainty, both the magnitude of it and the uncertainty around it. Certainly, I think some slowdowns more broadly in the data. The flip side is, the United States is a very dynamic, very resilient economy. And I think what you heard from the Fed yesterday is, while these shocks are significant, while growth is likely to come down, while inflation in the short term is likely to move higher, still there's a kind of underlying strength there that's going to see growth through.
When it comes to tariffs, all the players. Obviously, we're not in the Trump administration, but you know who they're dealing with on the other side. Do you think we get to a place where it's methodical reciprocity?
So I think what we've seen from other countries is, a likelihood that, this negotiation is going to play out in the backdrop of not just tariff announcements from the United States, but threats of retaliation from others. And I think that, I think one of the big questions as we roll the clock forward over the next 3, 4, 5, 6 months is, not just where do U.S. tariff levels end up, but where do other countries end up with their tariff levels? To the extent that, deals are possible, negotiations can reach some kind of resolution that ends up with tariffs perhaps lower than what gets announced on April 2nd on both sides. I think that's going to be ultimately a world that's healthier for growth and inflation globally. I also think at a minimum, as we roll the clock forward, we're going to get more certainty, and that's going to take some of that uncertainty discount off of economic forecasts as well as markets.
But if there's this reciprocal tariffs and then there's the hit back, the tit for tat, do you think there's a chance you can tip the United States into a recession? Powell said it's moved up, but it's off the table for now.
Yeah, like I said, I would just echo, Chair Powell. The shocks that we've seen are significant. We're going to see significant shocks. That's going to lower growth. That's going to mean, at least in the short term, higher inflation. But, that the underlying momentum, the underlying dynamism, the underlying strength of the U.S. economy is, quite significant. And that's hard to turn around.
You might agree with the Fed on that front. I get the sense you're not exactly joining the band yet of transitory. You're kind of on the sidelines saying, I'm not sure that that's actually the case. And you made a point about you're not totally buying the long end rally that we're seeing in treasuries. Can you talk a little bit about what you're seeing that makes you disagree with the Fed's assessment that we can resurrect this word transitory?
Yeah, so I think that, that when you look at the long end of the U.S. curve, yes, we've seen a rally over the past couple of weeks as these growth scares have worked their way into the market. But looking out over the medium term, inflation does look somewhat stickier. And obviously, we're going to have a shock on that in the short term. I think fiscal deficits are likely to be persistently high. And, when you face a backdrop like that, I think you do see pressure on term premium build up, particularly from the starting point we're at today. And that means that bonds are going to be less strong as diversifiers kind of rolling ahead as they have been the last 2 or 3 weeks and as they were, during the 2010s. And that means that investors are going to have to seek diversification in other places, whether that's managing fixed income in different ways or seeking uncorrelated sources of return that can provide that diversification.
Where do they find those uncorrelated sources of return? And I'm so pleased you brought up this topic because I've lost count of how many times we've asked this question over the last few weeks or so, haven't we? We've gone back and forth on this. Are we seeing a reduction in risk mitigation characteristics of treasuries? Over the last few weeks, I think slowly you've started to see some evidence of that.
Gold. I keep thinking gold. Are you just going to gold? And is that the reason why you see it keeping on rallying?
Yeah, I think that exactly to your point, John. Obviously at the beginning stages of the pullback, you saw really strong reactions from the Treasury market. That's diminished as we've gotten kind of deeper into this period of volatility. I think that's a harbinger of what's to come. At Blackrock, one of the things that we would say is you should, seek diversification from things like stable long-term cash flows that are less growth sensitive, that are more inflation sensitive, places like infrastructure. The thing that we really look at are are things like, our quantitative multi-strategy hedge fund, built on the back of 40 years of innovation and leadership. They've come through this period generating solid alpha. And what it proves out is, having a range of different strategies, a range of different ways of generating alpha. And in this environment in particular, what's worked is, strategies that are primed in market reversal periods, strategies that provide liquidity to segments of the market across asset classes that can generate alpha even in the face of market dislocation. And that's what investors are looking for.
John, it's not nearly as sexy as gold. Multi-asset, diversification, steady cash flow.
But, they've got things to sell. Like it's got a buzz.
Exactly.
Private markets, infrastructure funds, all of those kind of things. I'm not throwing shade. Total respect for the position. The answer used to be bonds. It used to be German bonds. And obviously that's not the answer anymore. How have things changed in Europe from your perspective?
Yeah, so I think it's actually a really interesting moment in Europe. I think the debate within the firm is this a trade or is this a more durable investment? On one hand, obviously, Europe, Germany has stepped forward with a set of fiscal policy changes that, as far back as when I was in the Obama administration, we were calling for. That is really tremendous to see. But I think that among the bellwethers that we're looking for is this going to be coupled by changes in the regulatory environment? The Draghi report talked a lot about the degree to which Europe remains uncompetitive in the technology sector, the types of spaces that really drive innovation and growth. If we see a turning of the page there, that might be, a precursor for a much more durable European trade over the long term and take it from just a 3-month, 6-month trade to something much more long-lasting.
I'm sitting here smiling. I've known you a while. It's nice to hear you talk about markets again. It's been too long. It's nice to have you back in this seat. I want to finish where we started. How are we going to make sure that talented individuals keep going down to Washington, D.C. to do the kind of work that you did, that Dalip Singh did, that Wally Adeyemo did? How are we going to make sure that continues?
So, I think when I look across, a number of friends that I've had who've served not just in, Democratic administrations, but Republican ones. I think to folks like, Justin Mucinich, who was the number 2 at the Treasury Department in the first Trump administration. I look into this one and see, really thoughtful, qualified people as well in important pockets of that administration. I think that the call to service is a strong one, and the call to deliver for the country is